All right. Here we are in studio. Anthony Smith, lead economist at FreightWaves. Zach Strickland, director of Freight Market and Intelligence. Welcome back to the live in studio version of Freightonomics. Yeah, I know, right? It has been a while. So, today we've got a big show. We've got intermodal and rail expert Mike Baudendistel coming on to tell us all about what's going on in that intermodal market and how it's relating to the freight market in general. But first things first, Anthony Smith, are you checking the social media account?
On the socials. And the other thing is like, not only is this our first time back in the studio in some time, but it's an hour-long show.
Hour-long.
So I am going to be on the socials. As you mentioned, I'm going to be monitoring LinkedIn for those comments, Facebook as well. So if you see anything, hear anything, want to be a part of the conversation, feel free to chime in. I'm watching closely.
Yeah, and again, for those of you that don't know, that may have, this may be your first time on Freightonomics, this is the podcast, or show, I should say. I got in trouble for calling it a podcast earlier. That is, a combination of the freight market and the macroeconomic environment, and we combine the two into one big ball of information and intel so that you can go on about your life, whether you are in the space or not, feeling more knowledgeable about your day, and you can make better decisions thereafter. So, without further ado, we started something last week, Anthony Smith, that it's kind of sticking with me because I'm a huge meme fan. We talked about the Suez Canal last week and that disaster, and it basically did something really unique, and it combined, it basically pushed freight market stuff into pop culture. The Suez Canal disaster, fiasco, whatever you want to call it, inspired all these memes. I was looking at memes from Teen Vogue, of all places, was getting in on this. So whenever you have a situation where the freight market, intermodal, or not just anything involving freight gets into pop culture to that extent and that deeply, it's definitely worth noting. But this week, I've got a few more memes, and they're going to be a little bit more trucker-centric, because we do have some things coming up that I think are relevant. We got Road Check Week coming up a little bit sooner than normal. For those of you that are familiar with that particular event, it does have an impact to capacity in the trucking market. Traditionally, you see a lot of the owner-ops and people come offline. They schedule vacations. This time around may not have as big of an impact because we're talking about the freight market that is extremely hot. And so shutting your truck down may not make a lot of sense while you can take advantage of a lot of spot rates. But also, Road Check Week generally gets timed right around Memorial Day in general, or one of them does. And so that does really lend itself to, more vacations and capacity coming offline. So this first meme of the week, if you will, I guess this will be you can decide what you want to call this section. Meme of the week?
I like it.
Yeah. So first meme of the week, anything in the truck I should know about? The DOT officer asks to the driver. Driver says, nah, just stuff you shouldn't know about. DOT, have a good day, sir. Now, we both know that doesn't happen.
It would be nice, I'm sure, for many drivers. They would love that situation.
Right. Yeah, so, it's kind of like the week where, the FMCSA, they get together with a lot of the administration, and they go out and they form these inspections. And it doesn't necessarily make fiscal sense at times for some of these drivers to take that risk because they could get put out of service, et cetera. So they just don't want to be hassled. Also, there's delays to service during that period of time, potentially. Hours of service regulations, you only have 11 hours of drive time in a given day. So any kind of disruption or deviation can really put you at risk for missing service and for service failures, upsetting your customers, et cetera. And that's just something that a lot of drivers don't necessarily want to deal with.
So, Zach, there's a few factors here because, like you said, it's almost like a vacation in a sense. And you're treating it as if it was almost like a holiday weekend or something like that. But when we're looking at this, it affects so many different parts. So I'm sure there are thoughts for carriers or shippers to try to get ahead of this, right?
Mm-hmm. Yeah, exactly. So this next meme, the next meme of the week, if you will, this one is pretty relevant, I think, to a lot of drivers out there. Now, again, 70 hours may be a little bit understated even. A lot of those drivers out there that are on the road work pretty much continuously throughout their week, really not getting to plan a lot of their schedule that much, especially for some of the larger carrier fleets. You're talking about drivers that don't, they're stopping at certain points along the side of the road and they're not working. You know what I'm saying? So this one I think a lot of drivers can relate to out there who are working, especially right now with capacity being so tight. Those hours, those weeks are getting extended. I have a 70-hour work week. You think that 40 is bad? That's cute. I do think 40 is bad. I think we should definitely pare that down even further.
The 30?
Maybe like 5-10 minutes, see what happens.
All right, that is quite a trim.
Yeah, just pay me all the money for doing literally nothing. No, obviously the economy would not find that too productive or healthy.
I mean, it did for almost a year.
Well played, well played. So the next one I think is more topical to what we're going to talk about today once we get Mike Baudendistel on here. You haul how much freight? That's cute. I always love that that's cute. You know what I'm saying? Like, yeah, the intermodal train there carrying tons of containers. We've all seen the mile-long trains. And we are going to talk to, Mike, about some of the differences between intermodal and van. Truckload capacity super tight, and shippers have to look at other options. But a lot of the shippers are already in the intermodal space. And we're gonna break that down a little bit. We're gonna bring on Mike here in just a second. Actually, let's go ahead and bring on Mike so we're ready for the story of the day. And that way he can chime in too. Mike Baudendistel, welcome to the show. Thanks for joining us.
Good to see you guys.
Yeah, man. So Mike Baudendistel, for those that aren't familiar, our rail and intermodal expert here at FreightWaves, knows pretty much everything there is to know about a train, intermodal container. I think he sleeps in one. You're looking at some sort of facade there in the background of his house, but he's going to break down for us a little bit about what the intermodal market is looking like right now. But first things first, story of the day.
Let's get to it.
Let's get to it. So this, I think, is also relevant and pertinent to you, Mike, in the way that we're talking about infrastructure bills. I think that we're going to cover this probably a little bit more in detail on another episode. But again, I'd like to get your take on what you think about some of this, Mike. So this is a John Gallagher report basically outlining that trucking jobs are going to benefit significantly from this infrastructure bill. A lot of the employment level in the trucking, environment, whether that be the over-the-road back office, situation, the employment levels have not recovered to the way that they were before COVID-19. And now this infrastructure bill, which has a pretty big impact to just everything in the economy in general from what it looks like. I mean, it is a huge, $1.9 trillion proposal, has to go through and get passed. Some of the political arena is going to have something to say. There's probably some of that's going to come back and forth. But the overall general idea here is that our infrastructure in the United States needs a lot of attention. Whether you're on the left or the right side or in the middle, that is not a debatable topic. There's a lot of things that need help and need work, and we need to do something about it. And of course, one of the big beneficiaries of infrastructure on both the economic side, where they can actually contribute and be employed by it, as this article outlines, and also in the way that they benefit from it from just having a easier day of having safer roads and travel networks is trucking. So that's kind of the big deal that's coming up out of this in the bit. So Mike, I want to ask you, what exactly do you think? Have you done any research on this infrastructure bill, and do you think that it's going to have any kind of significant impact on the rail side of things? The article covers truckload, but I'd like to get your thoughts on what you think about what this infrastructure bill could do to the rail and intermodal side, as well as how it relates to trucking as well.
Yeah, I think it could have a big impact on the rail carload business if you're hauling things like gravel, sand, those type of sort of heavy bulk materials that go into a lot of bridge and road type of construction. But it's another thing that when I was reading that report or the article by John Gallagher, the thing that I was thinking about is are you going to have the labor? Is there labor going to be available to handle all those jobs? Because that's something that's been in short supply. There's so much competition right now for what you would consider, blue collar type labor, everything from home construction to as we're so familiar with in the truck truck driver situation where there's a shortage of drivers there. And as we learned in the last year, there's been a lack of new drivers coming into the industry because of not having the capacity in the driver schools and so forth. But anytime I think you put a lot of heavy industry to work, there's a lot of that ends up going on the rail carload side of the business. So it's one other thing that I think is going to contribute to elevated levels of freight demand, and ultimately I think maybe labor inflation for a lot of those jobs.
Yeah, so jobs. That's a big topic
That's a big topic.
Your world. Yeah.
Yeah, it's been a big topic for me, especially looking at economic updates, more so on a macro level. But as the article mentioned, this is going to be one of the areas that's really going to impact transportation, not just for roads being improved or improved infrastructure for transportation, but the entire jobs industry. So that's one of the areas throughout the pandemic that has definitely, certainly everyone knows, has been impacted. And this is going to be an area that's going to help add jobs. So a lot of excitement. And one of the other areas is that I always forget to mention is that when we're looking at the economic movements and we see big things like this, it doesn't always move in unison with the freight market. So we see times of recession. It doesn't necessarily mean that transportation is going to go through a recession. We saw that just now throughout this pandemic. But this is something that we're going to see potentially, if it goes through as it is outlined and planned right now, that it would have a unison or a correlating effect with the current economic environment and growth along with the transportation industry.
Yeah, I think that's one of the things that's yet to be seen. Obviously, the infrastructure bill is months away from getting passed, more than likely. And then it has to go through some sort of adoption phase. Things move very slowly. So the chances are that this is not going to have a very near-term impact to the market. So it's not going to have any kind of additional, pressure, put any additional pressure on capacity with, new freight moving through the system. And as Mike, I think you said there, the carload section, probably going to see it before any trucking side thing happens first. And the carload section, of course, been relatively weak during the pandemic, as a lot of that stuff hasn't really moved so well, has it, Mike?
No, the rail carloads are still down year over year in sort of stark contrast to what we're seeing in the truckload side and on the intermodal side. And it's just really sort of kind of the tale of two economies, where a lot of what goes on the rail carload side of the business is heavy industrial materials. And last year at this time, companies were cutting back on their capital budgets, and that really had a big impact on the rail carload side of the business, in addition to certain commodities like coal, which is down. I mean, the one side of the rail carload business that's way up is grain. There's lots of demand to move grain, but aside from that, in total, the rail carload side of the business is still down, and there are other parts of it that are having their own issues, like the motor vehicles, which is struggling with the semiconductor shortage. Those volumes have been down double digits.
Yeah, so the carload section of rail, when we talk about it, we kind of talk about rail into two, it's like bifurcated into two sections. The carload section is very heavily tied to that industrial production number that Anthony likes to talk about. We see a lot of the raw materials, things like coal, rock, gravel, chemicals, things of that nature go through the carload side of things for rail. Coal used to be actually it still is one of the largest commodities shipped on a train, and it was essentially a cash cow for the rail operators. Now, intermodal volumes, which is what we're going to dive into today, the containers, all that stuff on the Suez Canal, on the on Evergreen's Ever Given. How we didn't talk about that more last week, I don't know. But that is intermodal containers. Most of those, of course, were 20 and 40-foot containers. We call those international volumes. And some of the stuff you see hauled on trucks, which Mike is going to give us kind of a background on that real quick. That's the stuff that we see more domestically on trucks. So, Mike, why don't we start off there? Why don't we define what the intermodal space is for those that aren't necessarily as familiar as you, kind of break down the basics of it. Tell us, what does it mean to be an intermodal carrier? Does it go on rail? Does it go on a truck? How does that work? What is intermodal?
So intermodal basically is a movement that travels on two different transportation modes. And the way we describe it, it's almost always talking about moving on the rail for the long haul portion of the move, and then moving on a truck on the shorter haul, either first or last mile, portion of the move from a rail ramp to the destination of where it's going. So you're really talking about a move where, because of the length of haul and because to take advantage of the lower per mile economics of railroad, when something is moving over a long length of haul, the rail is carrying the container or trailer on the long haul portion of the move. And so the whole reason for its existence is to save shippers a little bit of money. It's sort of the typical target is 10 to 15% savings off of a comparable truckload move is typically what shippers are kind of looking for, and usually where the marketplace tends to go. And then within intermodal, you really have to break down intermodal into two distinct segments. There's international intermodal and domestic intermodal, and international intermodal is moving the same containers that go on the container ship line. So those would be the same containers that were on something like that ever given ship, and those would go typically directly from the port onto a railroad and taken on the rail for the long haul portion of the move. So those would be 20-foot or 40-foot containers, and those are containers that are leased or owned by the container ship lines. And that's in contrast to domestic intermodal, which is intermodal that's moved in the same containers that only stay in North America. So those would typically be 53-foot containers or trailers. So it's domestic equipment, and a lot of that domestic equipment does contain imported goods that's taken out of the international containers and put in domestic containers, but it's moved domestically in equipment that never leaves North America. And that's a pretty significant distinction, because international volumes tend to be driven by a lot of the maritime data, things like maritime import shipments, the volumes of containers coming through the ports, those things, and they tend to be on longer contracts between the shipping lines and the railroads. They tend to be multi-year contracts. Domestic, on the other hand, there is a lot of imports there, but there's also a lot of just purely domestic shipments, and that's really what we talk about when we talk about taking trucks off the road and utilizing intermodal instead of truck in order to save fuel costs or to lower your carbon footprint and those type of things.
So, Mike, looking at the comments here, got a quick question. Sidetrack a little bit. Janet Turner asked, do you find freight moves as safe on the rail versus total over the road?
Do I find them as safe? Is that what you said?
Yes. Do you find freight moves as safe on the rail versus total over the road?
So claims, I'm assuming she's talking about claims and liability, things of that
nature.
Gotcha.
Yeah. Okay. Well, I would say that there is, some, I'd say, elevated risk of damage in intermodal. Now with intermodal, the trains are moved differently. You don't have the same type of yards. You don't use what are called hump yards, which can actually the rails cars hit each other. Those aren't used in intermodal, but because there are multiple points of handling, intermodal does have a little bit more potential for damage. I mean, I think those issues have sort of become lower over the years. So I think in terms of damage to goods from that perspective, maybe it's a little bit elevated of a risk in intermodal. But I think from a shipper's perspective, the bigger risk is that the goods won't get there in time, or because the intermodal does typically take longer. I mean, intermodal, I just mentioned that's at a discount to truckload, typically 10 to 15%, somewhere in there. But what a shipper is giving up is typically one extra day in transit. So you typically think about an intermodal move as being truckload plus a day. So Chicago to Dallas, instead of 2 days, maybe it takes 3 days. But then the other risk would be that the shipments are not at a consistent basis, where it would be fine if every third day that shipment would arrive, but you can't have a situation where some days sometimes it's two days, some days it's 4 days.
Yeah, so the intermodal sector, you have a lot more handling in the intermodal section, I think, is really what it breaks down to. Is you can get it off of a ship, and then it has to get onto a rail car or a truck even, and then then you have another potential transloading portion where it does get transferred off of that as well. So I mean, that's basically what we're talking about here is it is more efficient because it's traversing a longer distance without being disturbed, without traffic, without all these other factors kind of influencing it, on a train that basically has a very dedicated infrastructure. Los Angeles to Chicago, for instance, the single largest intermodal lane in the United States, is, or the largest in terms of total volume. And then, once it gets off the train there, it generally will get onto a truck or transloaded into something, put in a warehouse, et cetera, around all these DCs. So there's a trade-off here. What I think you're saying is it boils down to essentially cost and service to an extent. But I think our viewer here has a pretty good question as well in terms of like noticing that there's actually also a little bit of extra handling that's going to increase their the claims issues as well. Is that correct, Mike?
That's right. Yeah. So I think anytime there's more sort of points of handling, there's more that can go wrong. And I think that's part of the value that on the domestic intermodal side, a company like J.B. Hunt or Hub Group or Schneider, sort of some of the value that they add is that they are in charge of consolidating those multiple points of handling. So they're consolidating the billing, they're consolidating any sort of damage claim and those type of things. Being having one point of contact for the shipper to be responsible for all those different points of handling. I think adds a lot of value to the shippers, and that's part of the reason why I think over the years that those companies have handled the marketing for the domestic intermodal.
So one thing about intermodal that I think it really relies on is consistency. So intermodal volumes, they need consistent volume, they need consistent freight. The railroad providers will add cars here and there, but you really need to have this kind of consistent movement as a shipper to commit to intermodal because it is more, it's almost somewhat dedicated, is it not, Mike?
Yeah. So the shippers that tend to use intermodal, they do tend to be a lot of the larger shippers. So you would think of a lot of the shippers that would use intermodal are also using dedicated truckload services. So those would be shippers like Walmart, Target, Home Depot, Ashley Furniture. So it's a lot of these household names that are either retailers or CPG companies. Companies like General Mills. It's hard to move. Still hard to move. Refrigerated goods in intermodal for the most part. But for CPG companies that have moving goods that don't need to be refrigerated, like boxes of cereal, I think it's pretty ideal. I mean, a lot of those will travel a long length of haul. But you touch on something that's important is really the key thing with intermodal is density. And so when you look at density maps for intermodal, they're much more concentrated in those key corridors like your LA to Chicago, LA to Dallas, Chicago to Dallas, LA to Atlanta. Those corridors that are anchored by sort of mega cities on either side, and that's important because you really need a lot of density in order to fill up a train with intermodal trailers or containers, and so that's why intermodal is never going to be sort of the solution for a truck capacity shortage because it's really only relevant in certain situations, things that are less time sensitive and in corridors that have a tremendous amount of density.
Yeah, so it's not going to have, you can't move freight from, say, Greenville, South Carolina to Wichita, Kansas. Or I guess you could in some form or fashion, but you're going to have to take kind of a zigzag pattern in terms of getting it trucked to the railhead and then move it on a rail to somewhere. I don't know where exactly, the networks more than I do. I think that's really what the point is that these intermodal containers are good at filling like this gap of the long haul trucking sector where it is extremely difficult to manage networks, over the road networks, Los Angeles to New York, especially if you're coming in like the ports like we've seen over the last year, Los Angeles being such a overwhelmed vessel there out there in the on the Southern California, Los Angeles, Long Beach, really not able to handle a lot of the volumes. that are coming in. So the rail does perform a pretty useful service in terms of keeping that capacity at least somewhat available on the long haul side and the over the road stuff, especially for your larger shippers, larger accounts like your Walmarts and whatnot. Now, one of the big stories of the year has been the container issue. Now, a lot of people may or may not know about what it means to have empty container imbalances, in China. A lot of the, the exporters here in the United States are obviously very familiar. You touched on the grain side there with the carload guys. Can you explain a little bit about what it means domestically to have this container imbalance that we currently have in the United States and just globally? What does it mean? In truckload, there's like backhaul, head haul, and in rail containers, it's basically empties and loadeds. Is that correct?
Yeah, so I'll just take a step back and explain why there's this huge imbalance. Is really China and other parts of Asia are the manufacturer of the world, and the biggest consumption center in the world is the United States. And even think about where people live in the United States, about 45% of us live in the Eastern time zone, and then about 1/3 live in the Central time zone. And the biggest port of entry is LA and Long Beach, which is about 1/3 of all of our imports. And so imports come into the United States, thousands of miles oftentimes from where they're headed. And so that's what has brought in the intermodal as having an opportunity, is because those goods have to travel long distances. But because the U.S. imports so much more than it exports, that you can imagine that there's a lot more goods need to go from the ports of Los Angeles and Long Beach to, say, Chicago and New York than is going back the opposite direction. And so that's always the case. And this past year, it's gotten to be even more of the case than is typical, because COVID surprised everyone, and everyone, when COVID hit, everyone thought we were going to have this severe recession, myself included, because that's what happened in 2008 during the financial crisis. People bought less of everything. I don't think people were expecting that the government was going to give such big stimulus benefits and other types of benefits to keep people to spend even more. I think everyone was surprised by that. So everyone was had sort of ordered too little of everything throughout the supply chain. And as a result, now in the last few months, there's been this attempt to catch up on imports, and so there's been this tremendous elevated demand for imports to get inventories replenished. And when getting those imported goods to, let's say, the Midwest or Eastern consumption centers, they don't have to come through LA and Long Beach. They can go through the Suez Canal, or they can go through the Panama Canal and go all water route to the East Coast, and that's usually a lot cheaper. But it's also a lot slower. And time was of the essence the last several months, because inventories were so depleted, and you can't sell something without the goods being on the shelf. And so there was this big preference to move goods through the ports of LA, even more so than there typically are, and taking those goods by either train or truck to the destinations. And so the West Coast ports gained a lot of market share, but it also meant that there was a greater imbalance in containers, because the ships that come in through the East Coast ports, those are closer to consumption centers. The containers don't have to go as far. They don't have to travel return empty as often. But the containers that come in through the West Coast loaded, let's say go to Chicago and go back to the West Coast empty, that's been a bigger imbalance than is typically the case. And the reason now it's been such a big issue is that there's been a shortage of those international containers. Like there's been a shortage of a lot of things, and there's just
the 20s
a very
and 40s,
small,
the 20 and 40 foot container.
Exactly. The 20s and 40s they're manufactured in China. They're owned and leased by the steamship companies, and those are ones that go on the ship, and then they also go on the rail. And what the grain shippers, we mentioned them earlier, but some of those grain shippers will take advantage of that imbalance that I just described to fill those containers with grain for export. So they, because they're going back to the West Coast, anyway. But they've had a hard time doing that lately because the steamship companies, they don't make a lot of money on the backhaul. They make all their money on the head haul. And so it was to their advantage to just say, we're not going to wait for those containers to be filled with exports, return them empty. We'll give up that revenue. What we don't want to do is give up revenue on the head haul, and so that's created an issue for a lot of grain exporters. At a period of time when there's a lot of demand for grain exports, as China is trying to rebuild its hog population following the African swine fever that really decimated their hog population.
So, Mike, Zach, I have to pause the show real quick because we have to thank someone.
Oh, yeah.
We have to thank someone. I know it may have scared you a little bit. We have to thank someone. We have to thank Amazon Freight. Thanks to our sponsor, Amazon Freight, who knows you need more than another truckload service provider. You need a partner who can help you navigate the world of logistics and plan for the future. Amazon Freight is helping shippers move their freight simply and reliably, while backed by the innovation and expertise that is in the DNA of Amazon. Whether you have a few truckloads to fill or thousands to move, Amazon Freight is your opportunity to put Amazon to work for you. Visit freight.amazon.com to get started.
Yeah, right on. Yeah, almost you got to slide that in there amongst the conversation about intermodal. So, Mike, I want to show the audience exactly what we're talking about in terms of overall intermodal volumes. And I want to back up a little bit. We're talking about the containers creating imbalances and backhaul and head haul on the maritime side. But I want to show the audience, a sonar chart here showing, where intermodal volumes are, especially, compared to previous years. And honestly, Mike, it doesn't look like it's a dramatic increase in terms of year-over-year growth. And can you kind of add some color to this in terms of tell me am I missing something, or is this just kind of an issue of some sort of scaling? But it doesn't look like we've really missed out on too much intermodal activity. What's happening here?
Yeah, so that graph that you're looking at is the total intermodal containers. And we're comparing that to the last few years. And so, if you compare it to 2020, we're way up, over 20% higher than 2020. But you remember, last year, things sort of shut down in March, and there was this really sort of depressed period, at the last spring. So, you're right. When you compare that to 2019 and 2018, there's really not all that much growth, and that's been kind of in contrast to historically intermodal was the avenue for growth in the railroad industry. I mean, the bulk of what railroads move, when we talk about things like grain and coal and scrap steel and even building products and those things, they're typically not commodities where there is normally a lot of growth, with the exception of certain cycles and things. But intermodal was something different because it's a relatively new service, and so that had been sort of the growth area in the railroad industry. But really, sort of the last 4 or 5 years, it really hasn't grown very much. It's grown less than the economy and less than other areas of transportation. And I think that the reason for that is that the railroads have been mostly focused on lowering their operating ratio or improving their margins, because that's what the investment community was most focused on. And that sort of means taking prices up every year, regardless of what the economy is doing and what the capacity situation is, and not necessarily investing for growth, and in some cases rationalizing lanes and facilities and actually removing capacity from intermodal. So intermodal has lagged some of the other areas of transportation. Now that might start to change with this transaction with Canadian Pacific acquiring Kansas City Southern. One of the things I liked about that deal is that it was pro growth. I mean, it's really something where they talked about the synergies coming from revenue synergies rather than cost synergies, and I think that one good example of that is sort of that Chicago to Dallas corridor, where because the two rail lines were under different managements and ownerships on different sides of Kansas City. Now, if you bring all that under one umbrella, you can invest in a unified manner. And I think with intermodal, that's one thing that could create more opportunities for growth.
Yeah, so I think especially the rail side, they don't necessarily invest in a lot of growth. They've been talking about precision scheduled railroading, which is a very cost-oriented side of things. Again, this is infrastructure that is basically locked in place, heavily regulated. So it's difficult, I think, at times to invest in growth. And I think what you're saying is right in terms of the merger there, the potential merger, if it goes through, that you can connect now the whole North American continent on a single rail line. I think there's a pretty significant advantage to shippers in that regard. Do you agree?
Yeah, I think it's pretty interesting for shippers. And we haven't heard from too many shippers as to what they think of the deal yet. I mean, what they have said is that they want the Surface Transportation Board to, at a minimum, investigate the deal from a number of different angles, and consider it a major transaction, and not give Kansas City Southern a free pass, because they said the Surface Transportation Board said they would do that 20 something years ago. Industry has changed a lot since then, so they sort of needs to be looked at as the blockbuster deal that it was, second largest deal of all time. So I think that though most shippers do, I think will ultimately be supportive of the deal. I mean, it'll be interesting to see if any come out of the woodwork and say, actually, my rail options has declined. It's gone from 3 railroads to 2 railroads. I mean, the railroads themselves will say, well, no, there's no cases at all where that's the case. And in fact, in some cases, it's going from 2 railroad options to 3 railroad options. But I think of the argument that you extend the customer's reach with those 2 railroads under one umbrella. I mean, you could have something like grain movements from Canada to Mexico that never would have made sense before, or grain exports from the central, the heartland of the U.S. Out through the port of Vancouver, whereas that might not have made sense before. So I think in general, it's compelling for a lot of different shippers in the grain industry, as well as automotive and intermodal.
Yeah, I think the automotive industry for sure tends to benefit from that potentially a little bit more so than some of the other commodities that are out there. So, I kind of want to, fast forward a little bit into what we're looking at in terms of how does this interconnect and how does this relate to the broader freight market? Like, what insights can we derive from intermodal volumes in the United States? We have the domestic, what an international container is now. What is out there right now that can help people that maybe not, they may not be a shipper or involved in, some sort of trucking, or maybe they are in trucking. What can they derive from, these intermodal volumes and the various aspects of freight movement on intermodal, whether it be domestic, an empty container moving from Los Angeles to Chicago and back and forth? What are some of the key indicators that you can pull out of intermodal?
So I think the volume that's coming in through the various ports, to begin with, it's at an elevated level. It's still far higher than we've seen the last few years, and so a trucking company is going to have plenty of opportunity to move containers not just on the highway, from any of the port cities. The West Coast ports are still congested, so probably the easiest place in the world to get loaded if you're trucking company would be near the ports of LA and Long Beach, and so the West Coast ports, because so much volume is coming out of there, that's going to be just a place for carriers to get a lot of volume, and then for shippers, you have to sort of take into account that moving goods, eastbound is going to be, more difficult than it typically is, but moving goods westbound should be easier than it typically is. And, we have a data series in Sonar for intermodal, spot rates. It's the INTRM ticker for those of you that use Sonar. There, the rates from the West Coast ports, inland on the major lanes, a lot of those are up, over 100% year over year. But the ones going back west, lanes like, Elizabeth, New Jersey to Chicago, or Atlanta to Los Angeles, or Dallas to Los Angeles, those are down, and in some cases they're less than $1 a mile, including fuel surcharge. So it's something that even shippers that don't typically use intermodal, might keep in mind. And for the domestic shippers, those containers are not in as short a supply as the international containers, although there's capacity issues there, on the head haul as well. But it could create opportunities for shippers to on sort of the back hauls. What we're looking at now, that's on the screen, is the international container volume on the left and domestic container volume on the right. And that's one of the advantages of the data in Sonar, is we break that down, and you can see that it's really the volume has been weighted towards the international side of volume, and that's really been a result of the high import volumes, as well as the greater market share of the West Coast ports, because a much larger percentage of imports that come through the West Coast end up going on rail lines and moved intermodally than those that go through the East Coast ports. Most of the ones that come through the East Coast ports would be within a one-day truck of their ultimate destination. So a lot of those would be trucks. But we have seen stock analysts and take up their estimates for companies like J.B. Hunt and Hub Group, and really the right side of that chart, domestic, that's their market. It's less related to the international side of things.
So, Mike, more of a macro question on trends and recent events. Excuse me, I have a comment here. Zach Rogers said, last summer we were seeing reports of a lot of firms storing inventory. Sorry, voice is cutting out. Zach?
Yeah. Yeah, I'll go ahead and take over real quick. So I think basically, what we're saying is, Anthony needs water. But the more than that is that we, you're talking about these firms like J.B. Hunt, Knight Swift, Schneider. They all have intermodal divisions, and we're starting to see, the domestic side is, cranking along right now, and that side is looking up. Over the next year. I mean, there's continued growth on the maritime side. We've got import demand significantly growing year over year, and it continues to show a toward pace, and that's going to continue to fuel a lot of these intermodal volumes. Now, a lot of that spillover will go into domestic freight, and of course the domestic intermodal section, with the 53-footers and whatnot. So, I think a good use case for some of these intermodal volumes is just kind of seeing the overall health of the sector itself. Like, as we see, we don't have as wide of a band of, in terms of capacity, in terms of overall growth and decline. Intermodal is a relatively stable sector of transportation in the freight market. So even a little bit of growth is a pretty decent signal of health in the overall transportation economy. And some of these, with the maritime side, container freight fuels container freight. So a lot of the maritime freight does come on into the country. It stays on the container, or it gets transloaded into another container because it's it needs to be palletized to get into a dry van or some other type of equipment, more than likely. And on those containers, sometimes they'll just cram them in and just floor load the heck out of it, and and keep that stuff going. So I think looking at both international and domestic is a good way of saying, okay, so the international side, that stuff doesn't necessarily translate immediately into trucking. The domestic side kind of, complements trucking to an extent, especially on the longer haul type environment. But the 20s and 40s don't necessarily, I don't think, compete as much with the trucking side as they would, but it also is a pretty good leading indicator into the overall freight market in terms of freight volume growth, freight health in general. Do you agree with that kind of summary?
Yeah, I would say that certainly the domestic side of intermodal is much more relevant to the truckload industry, particularly the long haul truckload market. And so, sometimes I like to look at the domestic container volume that we have and compare those to long haul trucking to see, is one sort of gaining share versus another, which I think sometimes is an indicator of, are shippers actually finding, value in intermodal that they would, use, intermodal and, rather than truck. And if the service is not good, then they would, use intermodal, even with a steep discount. But yeah, I would agree with, the things you said there.
Good deal. And we've got Anthony back. So Anthony, would you like to continue your question now that you've been properly hydrated?
Hydrated, and I'm ready to go, Zach.
You should drink more water.
I got to take my own advice, drink more water. But I had a question from our very own Zach Rogers, or Z2, saying that last summer we were seeing a lot of reports of some firms storing inventory on intermodal cars to delay putting the product into warehouses where capacity is tight and the costs have been out of control. Warehousing is still pretty strained. Are we still seeing intermodal rail, which is a little bit cheaper than warehouse right now, or a little bit cheaper right now, used as a way to postpone the movement of inventory?
In terms of intermodal containers, no. I think that's a more relevant comment for some of the rail carload, side of the business. Whereas on the rail carload side, there is an excess of a lot of pieces of equipment, a lot of certain types of rail cars. There's the numbers of rail cars in storage is still at a very high level. But when you talk about intermodal equipment and sort of the main capacity constraint there is often the number of containers. If you sort of knew the number of domestic containers and had perfect visibility into how quickly those containers are turned, that's try to turn them about twice a month. That tends to be a pretty good indicator of the capacity out there. But no, not seeing a lot of storage in intermodal equipment. There may be some of that still in the rail carload, the rail carload side of the business because there is an excess of equipment there. There really is not anymore in intermodal.
Yeah, that's interesting because we were talking about how warehousing capacity has been so constrained here over the last little bit, and we heard a lot of people kind of sitting on some of these containers. And with the container shortage situation, it doesn't feel like the most economical path, and a lot of these service providers are probably not going to let you get away with that as much as they may have in the past, especially as they were they're probably trying to control their equipment a little bit more. So I want to bring up one of your charts here from Sonar, talking about the inbound international rail container volume. Now this is, a pretty good illustration of, the container imbalance. So you've got inbound loaded volumes, international volumes going into Los Angeles, and you've got inbound empties going into Los Angeles. Now this is something that Henry Byers brought to our attention the other day, and it basically shows the relationship of how the empties are now outpacing the inbound loaded volumes. And that to me is astonishing. With all this inbound, there's just not enough. I think it's a good illustration of how there's just not enough freight going back out west right now. And to me, this insight, especially for the domestic trucking providers, should be a pretty good warning sign of things to come, or at least at least in the near term. A pretty big warning sign. When the rails are having so much trouble or so many empties going back into the Los Angeles market that it's outpacing the loaded volumes, that to me signals that truckload providers or carriers in general are going to have trouble servicing that side of the country. Do you think that that's true? Do you think we're seeing some sort of like early warning sign for what might be a pretty tight market out there on the West Coast once again?
Yes, certainly it's a tight market on the West Coast. I think that what we're looking at there specifically is the inbound international containers that are empty in blue, and then the international inbound containers Los Angeles that are loaded in green. And so really you have two things going on there. You have that imbalance of freight where more is going eastbound than going back westbound, and that's even more true now than it typically is. But then also because of the global container shortage for the steamship lines, they want those containers back quickly, even if they're empty. So the container ship lines are less concerned about lots of equipment returning to them empty and losing out on a little bit of backhaul revenue, as long as they get that equipment back quickly, so they can get more of the head haul loads. And so the reason that's flipped, really it's been because of the container ship lines have wanted it that way, and they're the ones with the contracts with the railroads. They're the ones that are leasing that equipment. So it's a lot of that is coming from the container ship lines, in addition to a lack of freight that's going back west. But the shippers that are sort of left out in the cold are those that need those containers for export of things like export grain.
Yeah, so obviously the maritime container, the people that own the maritime containers are the maritime providers, the carriers, the Maersks, and the people like there's freight forwarders out there that also control or lease some of these containers, these 20 and 40-foot international containers as well. So that's interesting to me. So it's not necessarily that the domestic truckload providers should take this as a big warning, but it's more of a result of a lot of the maritime providers really kind of ignoring some of the opportunities on the backhaul side just to get those empties back to China. Is that right?
That's exactly right.
Okay.
It's all about the global container shortage and the need to get those back to China so they can get reloaded again, so they can have more goods that are manufactured in China and imported to the U.S.
Yeah. So I want to bring up one more chart from Sonar here today for you to kind of walk us through. This is the Intermodal Savings Index. So, this you touched on this earlier a little bit by saying that there's typically a target of around 10 to 15% of savings. Walk us through what this chart tells us about what's going on right now with the intermodal to truckload side.
Yeah, so it shows that based on this data, shippers are saving 14% of their freight bill using intermodal. And what I liked about what our data science team did here is that we're comparing contract rates, which as we know, contract rates comprise contract loads comprise most of the truckload and intermodal, and we're only comparing lanes with the same 3-digit zip, origin and destination. And so that's really important for intermodal, because the cost per mile is much higher at origin and destination, and so you can't really compare freight that's not originating, terminating really in the same spot. And so we're doing it down to the three digit zip. And based on this, the contract saving of 14%, it shows that the market is acting rationally. And then the other takeaway here is we saw that over the last year fluctuate from, say, 12%, go all the way down to single digits, and then hit a peak near 17% before settling into 14%. So my perception is that shippers can save more using intermodal when there's a tight freight market, and they save less during a loose freight market. Because when the domestic freight market is tight, the service may break down a little bit, and then it's you have to have a larger savings in order to move something via intermodal, where you could have even a worse service than truckload. But conversely, when the domestic freight markets are loose and there's plenty of trucks and plenty of capacity, if truck rates are low, you might as well just use it, go by truck, and there's less incentive to move it via intermodal. So it seems like, based on that metric, we're sort of settling into something that looks rational.
Yeah. So
I would also say that one more point is I would also say that the truckload rates are more volatile than intermodal rates, which is also part of the reason why that spread can fluctuate. So in a weak freight market, the truckload rates will fall much more than intermodal rates, and they'll rise more than intermodal rates when things are tight.
Yeah, so intermodal is a little bit more stable, consistent, but you know, after the dust settles with the pandemic in 2021, it looks like we're in this pattern for at least the foreseeable future for the moment. Do you think that intermodal might, you know, kind of fall out a little bit more after 2021? We've seen, you know, you talked about how some of the financial sector is kind of upping their value a little bit, their valuations. This year looks to be quite robust overall. And I know that some of them have increased their rates, their contract rates as well. They're a little bit slower or more sluggish to do so than the truckload providers. Do you think that this might be a headwind in the future for intermodal, or do you think they're going to maintain some resilience?
I think a lot of it is going to have to do with the service levels. I think if intermodal can have a service level that's truck-like, then it will, you know, at least maintain share, if not gain some share. But you know, if it doesn't, then you know you could see truck, you know, outpace intermodal in terms of volume. And then there's also the push by, you know, many companies to you know, be more environmentally friendly and have one more bullet point on their ESG slide. And certainly, I mean, taking truckload and using intermodal instead for those loads that make sense. You know, it's about half of the fuel surcharge. I mean, you can't deny that it's a more environmentally friendly solution. And, you know, every company now, it seems like they spend half of their investor relations deck talking about their ESG, you know, credentials. And so that, you know, may benefit, you know, intermodal. But I think if you're in charge of, you know, goods and a supply chain, you know, the biggest thing that you're concerned about is that the goods are gonna be there, and you're not gonna have to shut down a production line. You know, if they cost a little bit more, that's less of a problem for you than if the goods don't get there at all. So it really has to come down to service, I think, going forward. And I think in some cases, you know, like with the CP and Kansas City Southern, you know, deal, you'll see in some cases that, you know, that investment is going to, you know, increase, but you know, in other cases, you know, maybe the rails will still be concerned about the operating ratio to the extent that, you know, you don't have those you know, type of investments, or, you know, the intermodal won't be priced in a way that's really the way that it should be to attract incremental volume.
So, Mike, as you know, I always like to look at one of the goods that you cover within rail intermodal, and that's going to be looking at the industrial and manufacturing segment. In the last minute or so, I'm interested in hearing what you're seeing on your side of the analysis, because with manufacturing, I'm seeing ongoing and continuous expansion, slowly but surely. Are you seeing anything of evidence on your side?
I think it's a little bit, you know, different on a you know, sector by sector basis. I think there are some areas that are extremely hot, like the you know, housing, you know, industry, where you're seeing just lots of you know, building products you know, move on the railroad. You know, most of that is on the rail carload side of the business rather than, you know, intermodal. And then another area that I think is really hot is anything related to agriculture. I mean, you've seen the agriculture prices, you know, really, you know, shoot up. And a lot of that is related to exports, which is sort of driving a lot of the movement there. And you know, this push to, you know, have more, you know, plant-based, you know, foods is having an impact there too. But I think, you know, over the last, you know, year, there's been a you know, big decline in capital expenditures. But I do think a lot of the companies are ramping their capital expenditures back up, which should help the industrial economy.
Yeah, that's good stuff. So thank you again for joining us, Mike. I learned a lot about the intermodal sector. Myself, Anthony Smith, I know you did.
I learned a ton.
And I know you learned that you need to drink more water.
I got to drink more water. I always tell people drink more water.
Yeah. And thank you all for tuning in this week to this episode of Freightonomics. We'll be back to our normal bat time next week, right?
Next week, yeah, same time, Wednesday, 2.
Maybe.
They're
2
saying
p.m.
maybe.
Yeah.
No.
And of course, download the FreightWaves TV app on podcast players everywhere. Just look up Freightonomics or look up Freightcast and get every FreightWaves podcast available.
Bye.